Less bad, Sam. It's enough to buy European risk. Your thoughts?
We don't really like European credit at the moment. We'd rather be within investment grade in the U.S. at the high end and high yield in the U.S. on the high end from the quality spectrum.
Let's talk about that, Krishna. From an equity perspective, I imagine it's a different calculation to make. From a credit perspective, Europe versus the United States for you?
Well, so I think if you're a cross-border investor, would you find European credit assets very attractive at this point? And the answer to that is no. Having said that, there are lots of Europe domiciled investors who can only invest in in that particular continent, and to them, given what is happening in Europe in terms of the reacceleration or at least stabilization or troughing of their economy and the ECB balance sheet expansion and ECB easing, I think that bodes really well for European credit assets.
Robert Tipp?
Yeah, I think Europe is attractive. I mean, I think that the credit spreads are, 90% of U.S. levels, and issue by issue, some of the spreads in Europe are wider than U.S. levels, even for U.S. issuers. So I think, looking at both markets is worthwhile. Their relative value opportunities. But the technicals are very favorable there as well, right? So the demand to borrow in a place where the production is actually contracting is lighter. I mean, we have a big gross number here, but the net numbers this year in the U.S. are down in the 20s. And you have the ECB in as a buyer. So
this is a really important point for the United States. Next week, taking the headlines, I imagine, will be AbbVie coming out with this $28 billion monster issue, the fourth biggest corporate issue on record. You're saying on a net basis this year in the United States, the numbers just haven't been that big.
Right.
So how much demand will there be for an issue like that next week?
Well, I'm sure it's going to depend on pricing. There is a lot of money out there, and I don't think there's been any shortage of buyers for something that is correctly priced.
What do you think, Krishna? Well,
so I think $28 billion is a lot of dollars to be found. Having said that, it's a large issuer, has been a large issuer. There are specific issues out there where you can benchmark things. So I think the issue will actually go reasonably well. There are plenty of people who can buy a substantial amount of a large issuer because of the index weight, if nothing else.
There just seems to be red-hot demand for big, liquid issues in the investment-grade space, Sam. Do you expect that to continue?
I mean, it probably will, and if you look at the passive space, right, passive ETFs, we're not really huge fans of that debt-weighted view of the world, not late cycle, right? So we don't actually just want to hold the issuance just because it's big and it's liquid and whatnot. We want to have a quality bias. We want companies that are going to be able to pay back and have a buffer against any downturn that we might see. So for us, I really think quality and value, taking a factor approach with respect to investment grade makes a lot of sense.
Well, let's talk about the quality approach to this investment grade market and to the broader fixed income market with high yield as well. Quite clearly over the last few months, the likes of triple Cs have really lagged the high yield market. It's been extremely bifurcated. Do you see risk appetite picking up, Krishna, and the areas that have lagged coming with the broader market a little bit more?
Oh, absolutely. So I think, again, this is the troughing of the overall global economic cycle. And if you believe that, you can't have triple Cs out there by themselves when everything else is rallying. I think after people get convinced, as the equity markets are getting convinced today, that things are going to be okay and we will have a trade deal, triple C and other asset classes, and loans for that matter, asset classes that have been left behind will probably tighten as well.
Equity markets leading, triple Cs and loans. You see the stock market leaded this move?
Well, so I think equity markets have been fairly, because you had a lot more other options within the credit markets that you could buy, you didn't have to focus on the triple C or lower end of the market. And it's the same thing that has happened in equities as well. That is, the value part of the equity market hasn't rallied as much as the growth part of the equity market. They have started catching up in this treasury sell-off, and I think the same thing will happen with respect to triple Cs and loans.
Robert Tipp.
I mean, not only have triple Cs underperformed, but the downside risk for names that have missed on earnings and so on has really been spectacular. So there's no doubt it is a bond picker's market out there, looking at next year, people are expecting much higher defaults. As some of the issuance of recent years may have not as been underwritten as well as others, and as I mentioned, certain parts of the economy, as we all know, are underperforming. But I think in aggregate, your spread sectors are likely to continue to outperform. I think that the defaults are likely to probably undershoot or the disasters be avoidable more often than not, for people that are taking the time and putting in the effort to avoid them, and you'll get the outperformance.
Quick final question to you, Krishna. I know how bullish you are. I want to just try and work out just how bullish you really are. If you think this cycle is going to go on for a number more years and you think that the areas of the high yield market can really get a lift here, do you think we can test the cycle tights on high yield again? Do you think we can get anywhere near them?
Well, I think the higher end of the high yield market, we will certainly test cycle tights. So if you look at, work with the triple Bs because you have a very good data series with that. So I think the tight was 80, it is 101. Over the last 12 months, it's 101. I think by the time, end of next year, it's probably going to be closer to 80 than 120.